Marcus was 29, working as a federal IT contractor in Washington, D.C., earning $74,000 a year. He had a mortgage, a car payment, and about $2,200 in savings. Then, one October night, he got a text from his supervisor. Congress missed the deadline. We're shutting down tomorrow. No paycheck, no timeline, no answers. Marcus's story isn't unique. It plays out for hundreds of thousands of Americans every time the government shuts down. Today, we're going to break down exactly what a government shutdown is, what it does to the economy and markets, and most importantly, what it means for your money.
A government shutdown happens when Congress and the President fail to agree on a spending bill or a continuing resolution before the fiscal year deadline of October 1st. Without authorized funding, federal agencies must stop all non-essential operations. Now, non-essential doesn't mean unimportant, it means legally discretionary. The military, air traffic control, emergency services, those keep going. But national parks close, passport processing stops, and federal contractors like Marcus, they don't get paid and often have no legal right to back pay. Since 1976, the U.S. has experienced more than 20 funding gaps. The longest was 35 days in 2018 to 2019.
This is where Marcus's situation really stings. Federal employees, roughly 800,000 of them during a major shutdown, are furloughed without pay. But here's the key difference. Federal employees have historically received back pay once the shutdown ends. Congress has passed back pay legislation after every major shutdown since 1990. Contractors like Marcus, they're often out of luck. No back pay, no guarantee of future work. Beyond individuals, the ripple effect hits small businesses near federal campuses, restaurants, hotels, and transportation services that rely on federal worker foot traffic. And Americans waiting on tax refunds, loan applications, or federal benefit approvals, those processes grind to a halt.
Let's put a number on this. The Office of Management and Budget estimated the 35-day shutdown from December 2018 to January 2019 cost the U.S. economy over $8 billion. That's $3 billion in back pay for federal workers who weren't working, plus at least $5 billion in lost economic activity that was never recovered. Think about that. Money permanently lost from the economy, not just delayed. For Marcus and hundreds of thousands like him, the financial damage is real, immediate, and in the case of contractors, potentially permanent. And that's just one shutdown.
Let's look at the history. Since 1980, the U.S. has had 10 notable shutdowns. Most are short, under 5 days. Politicians feel the public pressure quickly and reach a deal, but a handful have dragged on. The 16-day shutdown in 2013 cost an estimated $24 billion, according to Standard & Poor's. And the 2018 to 2019 shutdown, at 35 days, was the longest on record. What Marcus didn't know that October night was that his shutdown would last 16 days. The data shows that even short shutdowns create measurable economic disruption, and the longer they go, the deeper the damage.
Here's what investors often ask first. Should I panic and sell? The historical data says, probably not. During short shutdowns, markets tend to shrug. The S&P 500 has historically averaged a modest gain during shutdown periods, according to data compiled by LPL Financial. But here's the nuance. Uncertainty itself drives volatility. When investors can't access key government economic reports, like jobs numbers, GDP estimates, or inflation data because the agencies that produce them are closed, decision-making gets murky. During the 2013 shutdown, the Bureau of Labor Statistics delayed the monthly jobs report. That kind of data blackout unnerves markets. Long shutdowns, think 30-plus days, start raising real recession alarm bells.
Let's look at the actual market data around two major shutdowns. During the 2013 16-day shutdown in October, the S&P 500 actually rose about 3.1% during that period, partly because investors expected a quick resolution. During the 2018 to 2019 shutdown, the S&P 500 was already in a December sell-off driven by Fed rate fears, and the shutdown added to the noise. The market dropped sharply in late December, then recovered strongly in January. The pattern suggests shutdowns alone rarely cause sustained market crashes, but they amplify existing fears.
Marcus checked his 401k every day during that shutdown. The lesson the data teaches: don't make emotional moves during political noise.
Not all stocks and sectors react the same way. Defense contractors, companies with large federal contracts, can see delayed payments and project freezes. Tourism stocks tied to national parks and federal recreation areas take a visible hit. The SEC pauses IPO reviews during shutdowns, which can freeze capital markets activity for companies trying to go public, and financial services companies waiting on regulatory approvals can face costly delays. For Marcus, working in federal IT, his entire project pipeline froze. His company, a mid-sized government contractor, lost 2 weeks of billable work. That's the kind of sector-specific damage that shows up in earnings reports weeks after a shutdown ends. Knowing which sectors are exposed helps you understand the downstream market effects.
Here's the number that puts the human cost into sharp focus. According to Lending Club's 2023 research, approximately 78% of Americans live paycheck to paycheck at some point during the year. For those workers, even a 2-week paycheck delay isn't an inconvenience, it's a crisis. Mortgage payments, car payments, groceries, those don't pause because Congress can't pass a budget. Marcus had $2,200 in savings when his shutdown started. By day 10, he'd burned through half of it. His situation is a textbook case for why financial experts consistently recommend building a 3 to 6 month emergency fund, because you can't control when Congress will manufacture a financial emergency for you. So what can you actually do? This is for educational purposes only, but here are the strategies financial planners widely recommend. First, build that emergency fund. 3 to 6 months of expenses in an FDIC-insured high-yield savings account. After his shutdown, Marcus opened a high-yield savings account earning around 4 to 5% annually instead of the 0.01% his old bank paid. Second, don't panic sell your investments. The data we just showed suggests markets typically recover quickly after shutdowns. Selling at the dip locks in losses. Third, if you work in a federally exposed sector, review your contract terms and understand your back pay rights. Knowledge is your first line of defense. Marcus's shutdown lasted 16 days. He didn't get back pay as a contractor. He burned through $1,100 of savings. But here's what changed. He immediately started building a 6-month emergency fund after it ended, and he stopped checking his 401k daily during political news cycles. Government shutdowns are real, they're disruptive, and they cost the economy billions. But for investors, the data consistently shows shutdowns are not market-ending events. They're political crises that create temporary noise. Build your emergency cushion, understand which sectors face risk, and remember, the best financial decisions are made with data and a calm head, not with fear. We'll link resources in the description to help you get started.
Everything in this video is for educational and informational purposes only and does not constitute financial advice. Please consult a licensed financial advisor for guidance specific to your situation. Past performance does not guarantee future results, and all investments